All right, good morning and welcome to Chapter 9, Section 2. As you're aware, the government collects taxes. They make us pay money. Okay? But which government collects taxes? Is it the federal government? Is it the state of California government? Is it the city of Covina or the county of Los Angeles? Which governments collect taxes? Well, the answer to that, of course, is all governments collect taxes. And that's what Section 2 is going to talk about. Section 2 is going to talk about which governments collect which taxes. For example, who collects income tax and who collects property tax and who collects sales tax, because different government levels collect different taxes. We're going to start first with the federal government. So on page 239 in your text is a pie chart, and that pie chart shows you the sources of federal government revenue. Again, revenue is a fancy word for money. So where does the federal government get its money? Well, you can see that the biggest slice of that pie, the blue one, is the individual income tax. The individual income tax is a tax on individuals like you, me, and your parents, and on our incomes. Okay? And there are other sources. We're going to go over those later on. Okay? But the biggest source of federal government revenue, the most famous of all the taxes, is the individual income tax. The individual income tax was established in 1913 with the 16th Amendment to the Constitution. When you have Mr. Lehigh's class, you're going to have to learn all the amendments, so you got a leg up now. The 16th Amendment was passed in 1913, giving Congress the ability to institute an individual income tax. Okay? So who is responsible? Which government agency is responsible for collecting the individual income tax? Well, the individual income tax is collected by the IRS. Those dreaded three letters, which stands for the Internal Revenue Service, or the IRS, which is a branch of the Treasury Department. They're responsible for collecting the individual income tax. And how do they collect the vast majority of the individual income tax? Well, those of us that have a job, obviously I do, but maybe you have a job. If you've ever received a paycheck, you're well aware of how the IRS collects the vast majority of our individual income tax. They take it right out of our paychecks before we ever get it. Okay? This is known on page 239 as the payroll withholding system. They withhold or take it right out of our paychecks. Okay? And those of you that have gotten a paycheck, you probably remember the excitement of your first paycheck and then said, hey, wait a minute, what happened? Why are they taking money out of my paycheck? Well, the IRS does have your employer withhold it right out of your paycheck before you ever get it. Okay? If the IRS is taking the money out of our paychecks, what is the importance of April 15th in most years? Not this past year because of the pandemic. But on or before April 15th of every year, you have to file a tax return. A tax return is going to calculate how much tax you were supposed to pay and compare it with how much they've already taken out of your paychecks. Okay? And for a lot of people, this paperwork, okay, a tax return is the paperwork that you file. Okay? Sometimes people use the term tax refund, but that's incorrect. The tax return is the paperwork that you file with the government on or before April 15th of every year that tries to settle up or calculate with the government how much you should have paid in taxes versus how much they've already taken out. Okay? So on or before April 15th of every year, you have to file a tax return. Okay? That's assuming you have income. Okay? If you don't have a job, you don't have to file a tax return. Okay? But assuming you have income, you have to file an income tax return by April 15th of every year. And the purpose of the tax return, pay attention, I'm answering the essay question. The purpose of the tax return is to calculate how much you were supposed to pay, called your tax due, and then we're going to compare that with how much they've already taken out of your checks. So all year long, they've been taking money out of your paychecks. How much were you supposed to pay versus how much have they been taking out? If what they've been taking out is more than what you were supposed to pay, well, then you get a refund. And most Americans do get a tax refund. Okay? On the other hand, if you were supposed to pay more than what they've taken out, you still owe. You still owe money. Okay? All right. So the most famous of all taxes in the United States is the individual income tax. The individual income tax is collected by the IRS. Okay? They take it out of your paychecks, but then on April 15th or before, you have to file paperwork. You have to file paperwork, and now we can do it electronically. But you have to file a tax return. And the purpose of the tax return is to calculate what you were supposed to pay and compare it with what they've already taken out. So what does a tax return look like? Okay. We'll come through all this here in just a minute. Okay. Many people are stressed out about doing their tax return because it's a very complicated thing. So we hire a professional to do our taxes, okay? Or we buy computer software to do our taxes. Okay? But the concept behind the tax return is fairly straightforward, and that's what we're going to go through right now. So I'm going to show you how to do your taxes. I'm also going to show you how some people cheat on their taxes. You won't cheat because I know you're people of character. But this is how a tax return works. All tax returns work basically the same way. The first thing that you have to report to the government is your income. Okay? How much money did you get that year? Okay? So what are your sources of income? Well, for most people, it's their wages. Okay? I have a job as a teacher. Every month I get paid, so I have to report the total amount of money that I got paid. Now, you don't have to remember all that. Your company will send you a form called a W-2 form. A W-2. A W-2 form to tell you all the money that you made from your job. So you don't have to remember every paycheck that you got. But at the end of the year, you get a W-2. Okay? But what else do you have to include as part of your income? Maybe you have a job that pays tips. What kinds of jobs pay tips? Well, food service, right? Waiters and waitresses. But where else do you tip? Ladies, you probably tip at the nail salon or at the beauty parlor. Gentlemen, hopefully you're tipping at the barber shop. Valet, people that work at the hotel or the casino that park cars, the valet gets a tip. Pizza delivery man and so forth. Okay? Are you supposed to report those tips as part of your income? Yes, you are. Does every person that make tips report that? They don't. Okay? And that's the first way that people cheat on their taxes is they underreport their income. They don't tell about all the tips. And the reason that they can get away with this is because a lot of times it's in cash and the government has no idea how much money you got in tips. For example, when I go to the barber shop, I pay in cash and I also give him a tip in cash. How much is he reporting to the government? Well, I think my barber's an honest guy. So if I give him a $5 tip, I assume he's saying that he got $5. But maybe he's only saying that he got $2 and he's underreporting his tips. Okay. If you have a bank account and it earns interest, Mrs. Ward and I have been saving money for a long time, so we have money in a savings account, and it earns interest every year. So we have to report that as income. Okay? And you might not make very much interest, but I do, because I have a lot of money in the bank. Mrs. Ward's parents passed away, and so she inherited some money. We stuck it in the bank, and it pays interest. Okay? Maybe you get lucky gambling. Okay? If you guys are 18, maybe you bought your first lottery ticket, or you've gone out to Morongo or one of the Indian casinos. If you earn money from gambling, you have to report that. In fact, you're supposed to report all sources of income. Okay? When you add up all of these together, okay, and any other sources of income, like dividends or something like that, we get to the number we call adjusted gross income, or AGI. That is all the money that you made. This is part of the essay question. Pay attention. Adjusted gross income is all the money that you made for that particular year. But is that what you pay taxes on? No. You may have heard the term tax deductible or tax deductions or tax write-offs. What does that mean? Well, after you take all the money that you earn, you now get to subtract. That's what deductions are, right? You get to subtract your deductions. Okay? And there are two types of deductions. What we call standard deduction or itemized deductions. Okay? First of all, what is an itemized deduction? What are itemized deductions? Well, this is where people find the tax return very complicated because you have to list all of your deductions. If you're itemizing, you list all of your deductions. Okay? One of the most famous tax deductions many people have heard of is if you donate to charity. Okay? If I donate to charity, like I give money at my church, okay? Or if I donate money to the Salvation Army, okay? Or the American Red Cross, or I give money to another registered charity. Okay? Anything that you donate to charity is tax deductible. So if I give $2,000 at my church this year, okay, every week in the collection basket, if I give $2,000, I get to deduct or subtract that $2,000. Okay? Other things that are deductible include your home mortgage, your mortgage interest. This is the biggest one for most Americans. Most Americans' single biggest deduction is their house, the interest that you pay on your home loan. A mortgage is a fancy way of saying home loan. Okay? Your property taxes are also deductible, and so forth. Okay? There are other deductions out there. Okay? Medical expenses that go beyond a certain amount and things like that. These are the three biggest ones for most Americans. Okay? So the government says you can choose to list them all, or you can take what's called the standard deduction. The government says, look, instead of listing them all, just take a flat amount. A flat amount. Okay? This past year, the standard deduction for a single person was $12,400. That's all of you, right? Single people. I'm married. So if you file what they call a joint return, if you're married, the standard deduction is $24,800 this year. Okay? Which one should you choose? Should you choose the standard deduction or should you choose to itemize your deductions? Well, whichever is a bigger amount. Okay? For many, many years, I itemized. But now, as the children are out of the house and my interest on my mortgage is not as great and so forth, and they really raised this amount. President Trump and Congress, they changed the tax code to really increase this number. It used to be a lot lower, okay? But they've really made this number a lot higher. Now I choose the standard deduction. In fact, almost 90% of American people choose the standard deduction because it's a bigger deduction than listing all of their deductions. Okay? All right. So whether you choose to itemize, that is list them all, or the standard amount, you choose whichever one's bigger. Okay? After you deduct from all your income, either your standard amount or your itemized deductions, you get to the number we call taxable income. And this is the number that you pay tax on. Is it possible that two people could make the same amount of income and yet pay different amounts in taxes? Yes. Okay? Because one has more children. Okay? You get a deduction. It's actually technically called a tax credit. Okay? But for children, okay, if you have more children, you get more money back. If you have less children, you get less money back. If you're single or if you're married, if you give a lot of money to charity and so forth. It's very possible that two people could have the same amount of gross income and yet have different amounts of taxable income. Okay? The key is to get this number as low as possible. Okay? So take all the money that you make and subtract out your deductions, either the standard amount or you're going to list them all and itemize them. Okay? Once you figure out your taxable income, you can now calculate how much you were supposed to pay. How much you were supposed to pay. Let's say at the end of the year, you were supposed to have paid $2,500. After you do all these calculations, you were supposed to pay $2,500. But all year long, they've been taking money out of your check, and they've been taking out $3,500. So each paycheck, they take out a little bit, they withhold a little bit in federal income tax. So at the end of the year, you've had $3,500 taken out, but you were only supposed to pay $2,500. Are you happy or sad? Well, you're going to be very happy. How much happy? Well, $1,000 of happy. You're going to get a refund, a tax refund of $1,000 because they took out more than what you were supposed to pay. What if that was the case? What if you were supposed to pay $4,500 and they've only taken out $3,500? Now you got $1,000 of pain because you still owe $1,000. So on April 15th, when you file that tax return, you have to send them a check for $1,000 because you were $1,000 short that year. And you're probably asking, well, Mr. Ward, why don't they just take out the right amount? Well, because everybody's situation is different. Okay? Your job doesn't know how much money you made in gambling. They don't know how much money you earned in interest. They don't know that you might have had a second job, okay? Because each job is going to take out money differently. They don't know if you had a second job that caused you to end up paying more in taxes. Okay? All right, so that's how you do a tax return. Okay? All right, pay attention. I'm going to help you answer the essay question. Okay? The individual income tax is the most famous of all taxes. Okay? It's a tax on individuals and their incomes. Okay? What type of a tax is it? Well, we learned before that it's a progressive tax. What does that mean? It's a progressive tax. Well, turn to page 249 in your book. At the top of page 249, they have some tax tables. Okay? Now, these numbers are way out of date. It says for I think those tax tables were from 2006. So they're way out of date. I mean, it's 2020. But the concept is still the same. Okay? And you'll notice that as each level of income goes up, as your income starts to rise, so does your tax rate. It goes from 10%, then up to 15%, then 25%, then 28%. It's a progressive tax. Okay? Who is responsible for collecting that tax? It's the IRS. And how does the IRS get most of your income tax? They take it right out of your paychecks using the payroll withholding system. Okay? But to make sure that they've taken out the right amount, on or before April 15th of every year, you have to file a tax return. And what does the tax return look like? It's paperwork that you fill out, maybe it's online, but it's paperwork that you fill out and send to the IRS that says, this is how much money I made, and so after we subtract all my deductions, this is what I was supposed to pay, and this is what they've already taken out. And hopefully, they've taken out too much. Hopefully, they've taken out too much, so you get a tax refund. A tax refund is the money that you get back. It's not the paperwork. The paperwork is the tax return. If you get money back, like in this case, you'll get $1,000 back. That's called a tax refund. All right. What other sources does the federal government have for taxes? Well, we're going to do that in the next video.